Hello, today is Monday, the 25th of February, 2008, and this is Brian Shannon from Alpha Trends. The market's closed. The S&P 500 finished with a gain of $1.65 today, or 1.22%. And, it got back above that level that we've been watching at 137.20. So I don't think that we're quite out of the woods yet, but there is the possibility that we'll now make a run for the next level near 140. And if you look at this market, as we have on the 30-minute time frame, we've been looking at this symmetrical triangle develop. And Friday we saw that the lower boundary of that triangle broke, and the market also took out this support near 134. As I pointed out, the way that a symmetrical triangle is supposed to resolve itself is in the direction of the primary trend, which is clearly lower for this market. That's what any technical analysis book will tell you. What any good technical analysis book will also tell you is that be prepared for false moves. If the market doesn't do what you expect it to do, from failed moves often come fast moves, as we get a large group of participants who were basically trapped under this level, maybe longs who gave up their positions when they saw that trend line break, shorts that came rushing into the market, and just an absence of demand initially. Then an unforeseen source of demand comes into the market, pushes it back up, and the market perceptions change based on fundamentals and technical events. We've seen recently that this market is very volatile based on the break of technical levels, and that volatility is further exaggerated by fundamental events as we get new news regarding the mortgage insurers and that sort of thing, that it changes people's perception. You can't look at fundamental analysis or technical analysis in a vacuum by themselves. They are just merely tools to help put some structure around our analysis so we can figure the most likely probabilities. It's not a science, it's an art. And when it breaks down, the proper thing is to look for short exposure. But when this market starts reversing back up like we saw on Friday, then the proper thing is to lock in those gains or minimize any losses if you're not quick enough, and stand on the sidelines and wait for further confirmation that maybe that breakdown will rematerialize. That wasn't the case here. As I pointed out on Friday, from failed moves a lot of times come fast moves. We saw that in here. The market held on to those gains today, added to them initially, held on to them on lighter volume as it pulls back. So as new material comes to the market, new information comes in, we have to be able to digest and process that to adjust our trading plan and look for the most likely the next most likely scenario, which in this case now is, again, the test of that 137.20 level that we've been looking at over the last week and a half as far as the upper boundary. If you remember, we've been stuck in this 134 to 137.20 range. Now it's back above 137.20. Chances are that we could get a run up towards these highs from late January. It doesn't mean you just go out and buy the market right here, right now. Again, we're going to have more fundamental news that changes people's perception. If this market breaks back down, then it's just going to add further confusion. And again, this is a trader's environment. You have to be quick to take action in here. And the encouraging signs that I had pointed out on Friday continue to be present here in the S&P 500, that we've now got a rising 5-day moving average, and we have this pattern of this level of resistance near 137, we'll call it, broken. What we would like to see for tomorrow is the 137 or the 136.50 level to act as a level of support going forward. From there, if the market can continue to build, then the proper course of action is to take long side trades over the intermediate term trend. It doesn't mean that anything's changed, though, on the bigger picture. The bigger picture is still clearly down, and that's why you have to be quick to take your profits in here and be quick to go either way whenever the market's telling you to change direction. If we take a look again at the average price since the Federal Reserve's 75 basis point cut here and then 50 basis point using the VWAP tool, you can see the average price since the Federal Reserve has cut those 2 times. Some say panically cut, but 134.5 or so is the average price. Now the buyers are firmly back in control since January 18th, or whatever this date is right here, January 22nd, when the Federal Reserve was cutting rates. So we still have a lot of conflicting signs from different time frames. Here on the daily time frame, you can see that again, this 10 and 20-day moving average are crossing back and forth above and below each other. That typically means just indecision. Obviously, we've got the volatility to confirm that indecision, and it comes, though, in the context of this bigger downtrend. So it still is guilty till proven innocent on the bigger picture. But when we go down to shorter time frames, and that's where you have to figure out which analysis is right for you. Are you a long-term investor or are you a short-term trader? Most of what I talk about here is from the perspective of shorter-term trades. That's the way I look at the market. That's where I think you have to look at it in this particular environment right now. But the market is just still digesting all this volatility from the news and volatility from price action. So there's still a lot of information that we need before we can say, hey, the market has bottomed out. But for now, it looks like this symmetrical triangle that we've looked at, it's breaking back up to the upside now. Will it hold on to those gains? No one has a crystal ball. I certainly don't. I don't know what will happen, but it seems as though, based on the 30-minute time frame, that the buyer, that we had a pretty good little shakeout here last Friday. The market reversed course. Now you've got people with a fundamental reason in their mind to buy stocks, as they think that the worst is behind for the mortgage insurers in that crisis. I'm not going to make opinions about that. I just look at price action, and price action is telling me that we've got a higher high here, and this would be considered the important higher low that I think the market will be safe as long as it holds above this level here, down near about 130. Let's take a closer look at that. That down near 135 and a quarter or so. That's really the best level of potential support right now for this market. And again, it looks like this level here is our next potential upside target. It's really at about 139.5 or so. So 139.5, and you look at the longer term, here's that trend line from the symmetrical triangle. And you could make a case that this is an inverted head and shoulders pattern. Let's not think too much about the patterns, because based on some of the emails that I got, people take these patterns way too literally. They're not meant to be taken literally. They only give us a potential idea of what might be coming in the market, but our plan has to be, when we implement it, we have to have some flexibility in that plan and listen to the only thing that matters. The only thing that matters is price action. If you're still stuck on a bearish resumption of this downward triangle, then you're not listening to the messages of the market. The message of the market is right now that the buyers have regained control of the short to intermediate term trend, and you've got to respect that, or just get run over basically by the momentum. The semiconductors are still within the confines of their symmetrical triangle here. Nothing's really changed in this market. You can see that this little trend line here kind of confines the upper edge of that. So I think that 29.75. If the semiconductors breach that level, then we might have a run up to about 30 and a quarter. But still a very badly damaged market, still under this declining 50-day moving average. It's been acting as resistance. So it doesn't look like there's much reason to really be involved or really interested too much in those semiconductor stocks. The IWM, this is the one that I thought had the best chance of breaking down, as it had the most defined upward trend line in here, and it broke the hardest on Friday, and that's where it said that even though it broke in here, complacency is the enemy, and that you want to make sure that you've basically always got a backup plan, and remember your stops on every trade. Hopefully you're not still short this or long the TWM, because now the market is back above this 5-day moving average. That 5-day moving average flattened out, and it's beginning to turn higher once again. Now it is still within the confines of this, back into this triangle. But, based on the S&P 500, maybe it's going to break higher. Keep an eye on this trend line tomorrow. Keep an eye on this prior level of resistance near about 72. We're still within a bigger downtrend. We've got that 50-day moving average declining. The market's about to maybe test that. And, expect still that we're going to see a lot of volatility in this market. Until this market can really get back above and hold above $73 a share, then you really don't want to trust these rallies for more than just a couple days. but you listen to the message of the market, and as the market makes these higher highs and higher lows, that's what you've got to listen to, and you've got to look at the one-day chart and say, initially it was a choppy market, but late in the day that's when we had more news from AMBAC or whoever it was, and the buyers came back with conviction once again. That's what you have to look at. In the last two sessions, late in the day, the buyers came in with conviction, and now the market is back within the confines of this range. It's back to that 71 level that we'd been looking at. So it's a lot of mixed messages is really the best, the most accurate way to look at this market. Is it making a bottom, or is this further distribution before the next shoe drops? Well, we've got so many conflicting signals that I'm not going to put my neck out on the line, and I'm going to stay, focused on the short-term trends. Make money when the opportunity presents itself to me intraday, and have my cash available for trading for another day, because whether you're bullish or bearish, it's been a frustrating market to hold an opinion, bullish or bearish, in over the last 3 weeks or so. The NASDAQ 100 also finished with a gain, this one of 0.5%. The Qs were up 22 cents. We saw that on Friday. This little trend line was tested. That's where the market did bounce from, and now we've got it coming back up to the upper end of this range. We've still got a lot of mixed messages in here. We've still got this downtrend, and again, 44.5 was the key level of resistance last week. I think that's still going to hold relevance this week as well. So while we've got some signs of recovery here, it's not a clear run out and buy the market by any stretch. So here we are back to that trend line, and this market further, the ranges further constrict, but we're in a primary downtrend, so caution is the most important thing in this market.